Okay, Carlos, we're live. Day two.
Woo! Hey, everybody, take it easy. Please stop with all the super chats.
Let
Please stop. No.
me see if it's live on YouTube.
Send your bitcoins.
Yep. All five people waiting for SolarEdge, and two of
Woo.
us. We're two of them.
Two of it. I'm in the chat yelling at myself. I'm gonna ban myself.
Second.
Some
All right, no
drama.
one cares about SolarEdge, but I wanted to, yeah, see the listen to the call basically, and I figured might as well, do this.
It's hard to pay attention to SolarEdge when you see what's happening on X with Nvidia right now.
Oh well, yeah, that's.
Bro, oh, holy fuck!
Well, let's take a look at NVIDIA. Okay, so hold on. Let me open up NVIDIA tab here. Uh,
I think I saw.
NVDA.
I think it was a mid actually who posted. There's like thousands of short call options for $1,300 that expire this Friday. Like thousands of
You mean call op? Oh, short-term call
them.
options?
Yeah, that expire this Friday at $1,300. Like
Well, right now, if you got them today and it went up 7%, your calls are
you're
printed.
doing,
Maybe sell
yeah,
tomorrow.
you're doing okay, but still, it's
Yeah.
fucking what? Yeah, what are we living in right now?
NVIDIA is doing pretty well. Let me see. What do they say? Forward P is 56. I mean, honestly, if they keep growing like this, I know people will keep talking about it that it's overvalued, but I mean, it's a growth company. It's actually growing. So
Yeah, but
I can't say it's overvalued right now.
they're making $700 processing boards and selling them for $40,000. I mean,
Well,
how do
that's
you go
amazing.
broke doing that?
It's
Very
not
simple.
broke. It's about the growth, and it seems people still want to buy them, right? So, uh,
That's my
I
point.
mean,
You got something that you made for $700 and you can sell it for
yeah.
$40,000. And the people that are buying them are the richest corporations in the world
Mhm.
that actually need them in order to make money. It is about as bulletproof a growth strategy as uh as you can imagine. And
I
they're
mean,
also the only ones doing it. So it's like they have full pricing power. They could charge 50,000, sixty
well,
thousand.
yeah. When I keep hearing the bear case about, there's going to be
Pullback.
competition for Nvidia, and people are making their own chips. I mean, look, it took Nvidia 20 years to develop this, and the CUDA architecture, right? The programming, all of those cores that they have across the board, you can program. So, I don't think that's going to be an easy thing to do to just usurp them. It's going to take a long time for Nvidia not to be important, if it ever happens, honestly. But
Well,
it's going to,
if you base your program on CUDA, then you would need to write your software to be tuned for a different chip, which was going to require work on the part of all of your customers. So if they're already writing for CUDA and they're optimized for CUDA, that's what Adobe does. Like they're optimized for CUDA, so when you put an AMD card in there, it just doesn't run as well. Why would you? You need to give massive incentives to ask these companies to rewrite their software to work
yeah.
with
I
CUDA.
mean, you hit the nail on the head. So if you're a company, what incentive do you have unless you save a fortune on these GPUs, but you can't even compete with Nvidia now. They're the only ones making them this good. So I don't think there's any competition at all, honestly, for Nvidia. They're clearly a monopoly, and this can go on for years, right? I mean, like I know we look back on it, but how long did Tesla go up for before it stopped? Was it like 2 years?
Mm, 2 years. I mean, it's a little bit different
But
because
I'm
there was a
saying
lot of
2 years,
shorts.
even for that to keep going up.
Well, I mean that proves your point. If Tesla can go up for 2 years like that, and it wasn't even as much of a closed situation as what Nvidia has, then what's the runway on this? Four,
Yeah, so
five.
let's say it's been a year right now, and at least another year, it can still. I'm not buying into this obviously because unfortunately I sold out, but I am not bearish on Nvidia, even if they have some missed quarters coming up. You know what I'm saying?
Yeah. No, I think the only thing that's going to slow this down is the spending. They need to have customers buying their products, right? But at a certain point, once all of the major companies buy all of the chips that they need, the spending's going to slow down. They're not just going to keep buying these chips
Well,
forever.
but the thing is, so I mean, AI is getting much more heated as we're watching. The AI wars are heating up. It doesn't feel like it's cooling down, right?
No, no, not anytime soon.
So
That is literally the only bear case is that the
it
big
cools
mega
down.
companies stop buying chips because they have enough. But what is
Right.
that number, right? How many
But
chips?
look,
need to-
but look right now. I mean, Meta and who was it? Meta and was it who else bought the most amount of chips?
Microsoft.
And Microsoft, that they bought the most amount of Nvidia cores, and Google was lagging, Apple was lagging. I think they're going to have to catch up. I think they're going to start buying Nvidia chips to catch up to the other guys because this is becoming real. And Apple, you said, I think we talked about this. They're going to come out with their own AI product that everybody believes, so they're going to have to catch up to this. So
But
this can go on for years.
I think Apple would use their own chips. That's a thing that we
Oh,
still
you
don't.
don't think they're building an infrastructure based on Nvidia GPUs? I mean, I don't know.
I
I
don't
think they're
think
going to start with Nvidia, a lot of Nvidia
maybe look,
GPUs.
maybe I mean Tesla's doing the same thing, and then you build your own chips on the side. But Apple's been building their own chips for years. I mean, these M chips didn't just pop up overnight. They've been developing them for years. So it'll be curious. It'll be curious to see what Apple's decision is. I personally can't see them buying an NVIDIA GPU cluster because the thing is they could have already, or maybe they do. Maybe they already have.
They've got to have something. I mean, it'd be impossible to say we have no Nvidia GPUs. That'd be an amazing
But
statement.
they don't use them in their computers. I mean, they went all AMD. They
Well,
have,
no, I understand why they
you know
don't.
what I
That
mean?
that that makes sense. Okay, but in terms of their infrastructure, where you are now requesting AI capability on the back end, you're going to need the best hardware. So, I think they're building out a massive Nvidia thing too. It's just the PO has not been publicized.
Hmm. Well, we'll
Yep.
find out.
We will, I guess, if they're open about it. Do you want to go to this call? Okay.
Yeah, I mean, can we watch it at faster speed? It's actually good to watch it this way because you can pause it and talk about it during the
That's
call,
true.
whereas we can't do
Share
that.
this tab. Okay, so here we are. I think we
I,
can you watch it faster speed? Let me
yeah,
see. Yes, you can. Okay.
yeah. But it
So
sucks
let's
when
let's
it's
listen.
audio only, like the video. That those Enovix calls are so much better that they're video, and they're boring as fuck, but they're at least you can get through them.
Well, we'll see what they say. Because I just made a big bet also on a spread as well right before this dump.
On
So there
them,
you go. On SolarEdge for 2026. So I have a couple of years for it to play out, but if they're it might be a tough couple of years for solar. I totally see that. Just like for Tesla.
I don't know. I get the idea behind. Oh, let me hedge my bets and bet against bet SolarEdge and Phase. I'm just not down with it. Like I'm not into this company.
Well, I get what you're saying. I'm hedging my bet on Enphase because if Enphase does well, SolarEdge can go to hell. I really don't care, obviously.
Yeah,
But
but
if SolarEdge does okay, then I will do all right with it. Yeah, meaning even if they don't win, as long as they're not this total turd, then I think those options I have, and I have shares too, will actually do well. But I have
I
2 years.
if anything, I would play with options. I just had such a horrible experience with the company, like a personal experience with the company, that I
I
could never
feel
buy their
you.
products again or invest in the company.
I feel you. We're not here to determine if SolarEdge is better than Enphase. I think both of us agree Enphase is the better company, right?
So then you're saying you're a degenerate gambler
I'm, I'm gambling on the
you have a
recovery
friend
of
who told you
solar.
how shitty the company is, and you're like, "What are the leap calls for 2026?" It's like, dude, I just
Basically.
it sucks.
Well, I'll give you why I did it. I mean, before we get to the call, the reason I did it is because I looked at the spreads, and if it hits between 100 and 150, I have a possibility of was it 5xing. So I figured, all right, I put 20K in. If it 5x's, I get 100,000 out, or it goes to zero, of course, because they're a total shit company. So if that happens, it goes to zero. I didn't buy all those shares. I didn't buy, so I consider it almost like at this point, the calls are probably better because I think you would lose more on the shares if it hangs around $50 for the rest of its time. You know what I'm saying?
Yeah, and that's
So
what it seems like it's gonna do.
it might. So in 2 years,
Years.
these calls might expire worthless, absolutely. And then I lost my 20K on it. But I'm assuming at least Enphase does better because that's my big bet. That's where I care what happens to it. But having said that, this still could be a 5x if there is some solar recovery within 2 years. If not, then well, I'm shit out of luck. What can I say?
Well, I like the stock price better because if you're trying to play
I
options
listen.
on
It's
it,
under $5 billion market cap. What is it for right now? I mean,
4.2.
4.2 billion market cap.
Yeah, but
So
even just for options, if you're looking to make a bet, 20 grand, then you can get a lot more bang for your buck on a $74 stock than you could like $100 and something dollar stock.
exactly. So well, we'll see what happens. Okay, so moving on to the call.
Let's just let's hear what these fuckers have to say.
Conference call for the fourth quarter and year ended December 31st, 2023. This call is being webcast live on the company's website at www.solaredge.com in the investors section on the events calendar page. This call is the sole property and copyright of SolarEdge with all rights reserved, and any recording, reproduction, or transmission of this call without the express written consent of SolarEdge is prohibited. You may listen to a webcast replay of this call by visiting the event calendar page of the SolarEdge investor website. I would now like to turn the call over to JB Love, Head of Investor Relations for SolarEdge. Please begin.
Thank you and good afternoon. Thank you for joining us to discuss SolarEdge's operating results for the fourth quarter and full year ended December 31st, 2023, as well as the company's outlook for the first quarter of 2024. With me today are Zvi Lando, Chief Executive Officer, and Ronen Faier, Chief Financial Officer. Zvi will begin with a brief review of the results for the fourth quarter and full year ended December 31st, 2023. Ronen will then review the financial results for the fourth quarter and full year, followed by the company's outlook for the first quarter of 2024. We will then open the call for questions. Please note that this call will include forward-looking statements that involve risks and uncertainties that could cause actual results to differ materially from management's current expectations. We encourage you to review the safe harbor statements contained in our press release, the slides posted on our website ahead of this call today, and our filings with the SEC for a more complete description of such risks and uncertainties. Please note, this presentation describes certain non-GAAP measures, including non-GAAP net income and non-GAAP net diluted earnings per share, which are not measures prepared in accordance with US GAAP. The non-GAAP measures are presented in this presentation because we believe that they provide investors with a means of evaluating and understanding how the company's management evaluates the company's operating performance. Reconciliation of these measures can be found in our earnings release, presentation, and SEC filings. These non-GAAP measures should not be considered in isolation from, as substitutes for, or superior to financial measures prepared in accordance with US GAAP.
Can you click forward? Because we can see.
Listeners who do not have a copy of the quarter ended December 31st, 2023 press release or the supplemental material may obtain a copy by visiting the investor relations section of the company's website. Now, I'll turn the call over to you.
Thank you, JB. Good afternoon, and thank you all for joining us on our conference call today. Starting with highlights of our fourth quarter results. We concluded the quarter with approximately $316 million in revenue. Revenues from our solar business were approximately $282 million, while revenues from our non-solar businesses were approximately $33 million. This quarter, we shipped 2.2 million power optimizers and 74,000 inverters. This quarter, we also shipped 133 megawatt hours of batteries. As reflected in our fourth quarter results and in the first quarter guidance released today, we continue to face challenges from general market dynamics, as well as the inventory levels of our products in the channels due to the abrupt slowdown in demand in the second half of 2023. That said, we undershipped end market demand by approximately $200 million during the fourth quarter. As we did on our last earnings call, we will share details of fourth quarter sell-through data in several of our major regions and end markets, and provide an update on our outlook for the normalization of inventory levels and return to revenue growth. Starting in Europe, following the unprecedented surge in demand for solar and storage products seen in 2022 and early 2023, the recent combination of increased product availability and an unforeseen...
Pause for a second. As we did in our last earnings call, we will share details of fourth quarter and in several major regions and end markets, and provide an update on our outlook for the normalization of inventory levels and return to revenue growth. Normalization of inventory levels. Did they say that they had a problem with production or overproduction?
No. So in the inventory channels, they're still clogged up. They haven't sold through all of their inverters that are out in the market. So
Same as Enphase.
Same thing, except they mismanaged it a lot worse than Enphase did, apparently,
Right.
And they're also become unprofitable as a company. Enphase is still a profitable company. We'll see how long that lasts too.
Right. Well, I have Enphase metrics up in a separate window here to compare. So what did Enphase say? Much of the downturn is explained by high interest rate, the end of NEM 3.0, and the other blah blah blah. Okay, they didn't say anything about inventory levels. All right, so let's see what's happened. Let's see
over here they say dynamics as well as the inventory levels of our products in the channels. So basically the channels are clogged up. They can't sell through all their products. That's the bottom line right now.
Due to the abrupt slowdown in demand.
So they're making less money, and that means they have to make less inverters and they're not going to send out any inverters. What's the point? Because the channels are all clogged up,
Yeah, well, the question for Badri last time was, are you going to lower prices to incentivize the sell-through or not? And he says no. So let's see.
He's not doing it.
If they had to do that.
Well, yeah, let's listen to the rest of this.
Has led to elevated inventory levels across Europe. As it relates to demand across our residential products, sell-through on a dollar basis in Europe in the fourth quarter was down approximately 35% quarter over quarter. Sell-through of our residential inverters and optimizers was down 39%, while sell-through of our residential batteries was down 16%. This decline from the third quarter to the fourth quarter is more pronounced than the 10 to 15% seasonal decline we typically see in Europe in the fourth quarter, largely due to early onset of winter, combined with the market dynamics in Europe associated with high interest rates and regulatory issues and uncertainties in some countries. Looking past the winter season, we expect a more positive environment in the European residential markets. In Germany, regulatory policy remains quite favorable, despite the recent headline news about renewable subsidy cuts, which do not impact residential solar. In fact, a portion of the subsidies that were eliminated were caps on electricity prices that were put in place to protect the consumers from soaring energy costs seen in 2022. The elimination of these caps is expected to result in higher electricity prices for the German consumer in 2024, improving the return on investment for solar installations. In Austria, the fourth quarter was abnormally weak as the market paused in anticipation of the elimination of the solar VAT tax, which came into effect on January 1st of this year. We expect this market to accelerate in the coming quarters now that customers can benefit from lower cost solar. Moving to the Netherlands. Following the first half of 2023 that saw installation rates nearly 50% above 2022 levels, the market by the fourth quarter fell more than 50% from peak levels due to uncertainty around the Dutch election and potential policy changes in net metering. While the recent decision by the Dutch Senate to keep net metering in place for the foreseeable future relieves some of the uncertainty in the market, questions remain as to the eventual policy around net metering. Therefore, while we believe the market will likely react positively, it remains to be seen if it will return to 2022 levels. This decision, however, will slow down the transition of the Netherlands to a battery market. We are well positioned for a solar-only Netherlands market, as well as for the transition to battery and self-consumption that will take place in a few years' time. I will have more to say on the specific product that we have introduced to capitalize on our market-leading position in the Netherlands in a moment. Considering these country-specific dynamics and typical seasonal patterns, we think European residential installations will bottom in the first quarter and improve thereafter.
Okay, you can stop.
Moving to our European commercial business.
Enphase said the same thing, that it looks like we're at the bottom. All right.
I mean, I don't know if that's true, honestly. I think it's going to take all year into next year to play out. How can you call the bottom? Because the thesis of rates obviously destroying solar adoption seems to have played out pretty perfectly, right?
Seems like most of this is regulatory. It's not
Well,
even
on
rates.
top of it, you're right. The regulatory, the net metering, people like California and
Metering, they said they cited some issues politically, and then the end, what is that, the VAT or the value that the price of energy.
right. Well, recently I think oil has been going down and gas has been going down. I'm not sure how it is in Europe, and I still think those prices are pretty expensive. But my point is, I think it looks like there's an attack on net metering across not only California, which is happening, but it looks like, what did he say? Netherlands? Where did he say it was happening? Here, let's take a look. I think he said Dutch. The Dutch. So it seems to be an attack in multiple countries on net metering. But I don't know if that can stop solar adoption, but can it slow it down? It looks like it can, obviously,
Check this out real quick. I'm just doing a quick search. This was a day ago. This European natural gas energy crisis. Over the Dutch benchmark for European gas prices has seen a significant drop in February 2024, falling below reaching levels less than the summer steep decline over 50% compared to the same year ago. Mild winter, subdued demand for heating. European natural gas prices no longer a cause for concern. So they're back to 2021 levels.
I mean, that's going to affect, like that would affect adoption. So once again, I don't know if this is going to take a couple of quarters, like he's saying, but maybe that's the trough. Maybe the couple of quarters is a trough before we start seeing some positivity,
Mm-hmm. All right, let's go.
Okay.
Let's see what else he says. You got to share the screen. As I'm just staring at you. I didn't know Amit was doing a call. What call?
Agri-PV, renewable energy communities, and solar on multi-dwelling units, or MDUs, in certain countries on the continent. Moving to the U.S. residential market, dynamics here are relatively unchanged from what we witnessed in the second half of 2023, namely a significant slowdown in installations in California due to the rollover of NEM 2.0, and continued slow growth in the uptake of NEM 3.0, and in the rest of the country, slowness in markets with lower electricity prices. Sell-through of our residential products in the U.S. in the fourth quarter was down 8%, with inverter and optimizer sell-through down 12%, and battery sell-through up 43%, as more customers realize the benefit of our DC-coupled storage architecture. We do not expect significant changes in the residential market dynamics in the U.S. until such time as interest rates decline. In addition, the market should improve as installers are able to.
That's the only benefit. The only benefit to the NEM 3.0 thing, at least out here, is that it does incentivize people to get more batteries, and I think they get better profits on the batteries. What did he say? The batteries are up.
Yep.
Batteries sell through up 43%.
Yeah, but it's not enough to offset, I guess, just the overall decline because of NEM 3.0. So, yeah, I mean, I didn't think NEM 3.0 would have such a deleterious effect, I guess. And it has totally, I don't know, it seemed like it has crushed California solar.
Well, at least in the short term, because there's a lot of people that we're just so aware of NEM 2.0. So what you need is you just need more time to pass. In the same way like rates, people eventually get used to the higher rates. It needs to pass. And so new people that come into the system don't even know anything about NEM 2.0.
That's true. They never even consider it. All they're considering is the battery system and all that.
Right. They would just say, okay, this is the way it is. Got to get a battery, et cetera, et cetera.
Yeah, I did. I think I forgot to mention it, but I talked to my brother-in-law about SolarEdge and Enphase. He's never really believed. He has Enphase on his home too now, but he's never believed like investing in Enphase and SolarEdge. And he said after watching it for this long, he works on Wall Street. I think I mentioned that to you before, but he said this is all an interest rate story, and it was interesting to hear the Wall Street take on it. That as long as interest rates are high, I don't think Wall Street is interested in companies like this.
Hmm. Oh, it makes
So
sense. It's
when
gonna.
it goes down, then all of a sudden, like, oh, I can play this as the interest rates go down. So the good news is, yes, we're early, but we know they're coming down. Like it's happening. We don't know what day, we don't know what month.
Some point this year. I
Some
think
point this year, it's happening over next year, and they're going back to maybe not zero, but they're going to be pretty freaking low. I think that's when, and I hope it's in time for my options to turn around because I got until 2026.
and living on the edge, living on the solar edge.
Living on, I'm edging SolarEdge. But I'm betting in 2 years that we have a good turnaround where it would make sense for me if SolarEdge does not completely capitulate. It seems like it has capitulated, but I mean, and it goes back to my 100 plus, which I'm betting on. I think it'll do well, but it's a big if right now even in my brain.
Right, but what you're talking about the stock and the company interchangeably.
Yeah.
And it's you got to be clear. The stock's going to do well because people will pile on anything that's been beaten down that has any sort of benefit that's going to come from the lower rates.
Well, right. So that is the bet. There is sort of a bet there on that. I agree with you there. Okay, so moving on.
From the various incentives offered by the IRA. The commercial market in the U.S. continues to be the most positive segment from a growth perspective. In fact, commercial sell-through in the U.S. was up 22% quarter over quarter to hit a record high. Given the continued drive towards net zero carbon emissions by enterprises, our new product introductions, which serve broader portions of this market, and the expected benefits from the availability of our IRA-eligible products, we expect a positive 2024 for the U.S. C&I market as a whole, and for us as a leader in this market. Moving to the rest of the world, we do not see dramatic shifts in overall revenue over the next several quarters outside of typical seasonality.
So hold on, C&I. I think it's talking about commercial. What's the I? Industrial? Commercial industrial? So he expects a positive 2024 for U.S. C&I market. I think he means commercial. That strictly commercial.
That makes sense. And they do more commercial installations.
Yeah. I mean, they could be being pushed out of the residential by Enphase, honestly. Small installers don't want to deal with their shit, basically, and they're going to have to be more commercial enterprise, And that means Enphase really has no competition besides maybe Tesla moving up at some point. Who knows when? Right.
We continue to see good potential in Australia, Taiwan, and Thailand, where a rapid shutdown requirement for commercial rooftops was recently put in place. Moving now to our current expectation for the inventory clearing pace. In the fourth quarter, sell-through from our distributor customers was slightly below $500 million, indicating that we undershipped demand by approximately $200 million. Considering the market dynamics that we have discussed, as well as normal seasonality patterns, we expect to reach an underlying business run rate of $600 to $650 million in the second half of the year. Our expectation for the first quarter is that sell-through should be flat to slightly down versus the fourth quarter, meaning we expect to undership demand in the first quarter by approximately $250 to $300 million. Looking ahead, we expect underlying demand to improve in the second and third quarter, given typical seasonal improvements and market dynamics discussed earlier. Therefore, we expect to undership less in each successive quarter after Q1 until inventory in the channel have normalized by year end. With our expectations on reduced revenue levels over the course of 2024, we have made and continue to implement several measures to align our cost structure with the projected business outlook, including a 16% reduction in our workforce that we announced last month, closure or capacity reductions across our manufacturing base, and exiting from certain lines of business. Through these actions, we make sure not to impact our R&D activities in the development of future products that will enable us to maintain our strong position in this market, which we remain optimistic about over the mid and long term. Ronen will discuss the financial impact of these measures in his remarks. Moving on to operations. We have reduced our manufacturing footprint globally. At the same time, we continue to ramp manufacturing at our U.S. facility, where we shipped over 90 megawatts of Energy Hub inverters in the fourth quarter. We expect to manufacture over 200 megawatts in the first quarter, and to hit a quarterly manufacturing run rate of 500 megawatts in the second quarter. Additionally, we are on target to begin producing optimizers and commercial inverters at the second contract manufacturing location, with small quantities expected in the second quarter and significant volumes in the third quarter. Moving on to products. We have recently begun commercial shipments of 3 new products that address market segments that we did not previously serve and that we expect will positively contribute to our business in 2024 and beyond. Starting with the recent announcement of the commissioning of the first U.S. installation of our 330 kilowatt inverter at a 1 megawatt ground mount project in California, following initial installations in Europe and Asia. This inverter is coupled with our new H1300 2-to-1 power optimizer. This is our first optimizer equipped with high-frequency DC power line communication technology, which allows communication with large number of optimizers for ground mount applications, as well as improved remote software upgrade capabilities. We are excited about this product and its application in the community solar and agri-PV markets, and will continue to ramp production for further deliveries in 2024 to US, Europe, and Asia. Second, in the fourth quarter, we delivered to customers in South Africa the first shipment of our 102 kilowatt-hour commercial backup battery. This represents an entirely new business opportunity for rooftop and ground mount solar, with applications across many geographies and customers. We intend to roll out the product in multiple European countries in the coming quarters as we certify the product in various regions.
What was that?
That's a Model X battery.
Right, 122,
Seriously,
102 kilowatt hour.
That's more. That's 25 kilowatt hours more than a Model Y on your roof.
Yeah, that's pretty small though, considering they're supposed to be doing bigger installations, right?
Well, that's
Should be megawatt. It should be not kilowatt.
That's a backup battery. Think about that. That's a backup battery. The power walls are like 13 kilowatts.
Yeah.
So that's like almost 10 times. That's massive.
Third, our tracker product continues to gain momentum. To date, we have installed approximately 37 megawatts and have already confirmed orders for approximately 110 additional megawatts that are scheduled to be installed this year. This tracker is optimized for installations on constrained and sloped terrains, eliminating the need for costly grading and construction, and as such is well suited for community solar and agri-PV. The trackers come with advanced software that is designed to optimize production, predict weather changes, maximize bifacial gains, and respond to remote commands. Each of these three products by themselves and in combination allow us to provide our customers with an optimized solution for multiple special outdoor applications like floating solar, community solar, carports, agri-PV, and others.
So you see the way they're heading into this commercial sector. It looks like with tracking even this solar and agri-PV, I guess agriculture, right?
Mhm.
So, and they have trackers. So apparently they're selling trackers. This tracker is optimized for installations on constrained and sloped terrains. So it looks like they have actual solar trackers now too with their business.
Mm-hmm.
Yeah, maybe they're just going, head on commercial because that's where they see they have the opportunity.
Well, that whole thing, the agri photovoltaic, I mean, that's just a massive amounts of real estate, like space. So you can build massive grids, which is a lot of products, right?
I don't know. Once again, like a lot of people discount, they keep saying commercial solar is bigger than residential. I would disagree. I would think there's more money to be made for Enphase than there is, like obviously for someone like SolarEdge. Just the number of houses, number of people, and the upsell that you can charge for your products. Because if you're doing a commercial installation, your whole point is driving costs down to nothing.
Yeah, but you're installing more product. You can give them some sort of economies of scale.
Well, that's what I mean. Like
in general, will be bigger.
But that means the gross margins would tank, which they are.
Yeah, but if you're pushing twice the volume, your overall revenue is still more.
Yeah, no one's saying they can't do well, but I don't think it's going to be as beneficial to be in a solar company that's only or mostly commercial and not residential. I still think there's a massive residential market, and it just makes sense as energy goes up that more residential will convert, even if the cost is slightly higher. You know what I'm saying?
Yeah.
Initially.
I hear you, but think about the cost of acquiring all those individual residential customers to make the revenue for one commercial sale.
Well, yeah, that's true. But remember, Enphase doesn't actually acquire customers, right? We talk about it. They have an installer network. The installers themselves their businesses acquire the customers. So
all I know is when I was working in the alarm business, we made exponentially more money on a commercial job than we did residential.
You mean, but that's like, right, because one job.
Yeah.
But if you add up all the tiny little residentials, wouldn't that be more than that commercial job? You see what I'm saying?
Yeah, but
just the amount of jobs.
Yeah, but no, I don't think so. The revenue was more from the commercial because the contracts are just so big. But keep in mind that there's a big difference between those businesses because, like in the alarm business, for example, there's a component of we're going to get reoccurring revenue every month. We're going to charge you a service fee every month to connect, to be able to notify the authorities if there's an issue. So sometimes you'll take a little bit less money on the front end so that you can just get that reoccurring revenue every month. And slowly over the years, you raise the price of it, right? So you could start at $29.99 a month to your commercial customers, and eventually maybe you go to $34 a month. With solar, there's no reoccurring revenue. You get the installation and then that's it. That is something that I do think these companies need to start considering as a way of monetizing your existing base on a per month basis.
Yeah, I mean, it looks like solar. I think we talked about this before, but Solar is going probably towards the way the car business did their financing arms. Do you know what I mean? It
But
seems
if
like eventually companies like SolarEdge and Enphase will be the financiers, just like GM is a finance company as well and sells you the vehicle.
that would make
And
sense.
you don't buy a car outright in most cases, you know?
That would make sense.
Yeah, I think so,
Yeah.
and I think it would prevent them from being so hammered in the future because they wouldn't be so dependent on, you know, the environment they're in if they can actually finance solar installations
Or
and
even if
have
they just
different.
figured out a way to create some monthly service. Like I don't know about you, but I would pay $20 a month if whether my solar company or Enphase had a service to come clean my panels every month.
Yeah, $20 is not enough for someone to get on your roof. That's the problem.
But right, but the point is at scale. If you think about how many customers you have, say you have 1,000 customers.
Well, let's say it takes 30 minutes and best to clean all your panels.
Yeah.
And that's being generous because it's probably like an hour. But let's
Mhm.
say 30 minutes. The guy still has to get up there, but let's say all of it is 30 minutes. It's an 8-hour work day. That's 16 customers max. He doesn't eat lunch. And so
Say, right?
multiply that together. Like you're not rich.
But you're only visiting that customer once a month. And the other thing is that gives you an organic touch point for upselling later in the future. So
Yeah,
you're
I'm not
there.
saying
You
it's a
got
bad idea. I think the price
like,
is wrong.
hey, I see that you got an EV. We also offer EV chargers. Or hey, there's a storm coming, and there, if you want a battery, we can get it installed here within a week. It's also just a good touch point. Plus, you drive the truck into the neighborhood. The neighbors see the truck.
I agree on that.
There's other
Advertising.
benefits that don't necessarily fit into a spreadsheet, but there's some benefit there that given a big enough push for it, it can start to affect your bottom line. Like I would, if I had a solar company, I would do that. I would offer that.
Well, once again, it's the math. So I'm not sure what the minimum requirement for the guy that he has on the ground. You have to at least be more than that minimum requirement, even just to keep him busy on a free day. You know what I mean?
Yeah. Oh, well, if you have enough customers, that guy's never going to have a day off
That's
because you're
possible
you're
too.
trying to see those customers once a month. So you divide up your customers by 30 days and make sure that you hit them all once a month. It's like my pool guy. My pool guy comes here once a month for $70 or for $90.
Well, this is what I mean. Your pool guy's getting $90, $100. The guy climbing on your roof, he gets 20.
This guy's coming here 4 times a week, 4 times a month, once every week, for say an hour to clean the pool, and he's getting 90. Actually, no, he raised his rates. He's now $130 a month, and the guy has, I don't know, 1,000 pools. You know what I'm saying?
Yeah, this is what I mean. Like, so if the
Money.
solar installers figured out a way to get $100 out of you, that would make sense.
Mm.
At 20, I'm not sure if it makes any sense. But either way, they do need recurring revenue. That's the point.
That would be the thing. Yeah.
Okay, so let me go on here.
Let's talk about software. We have been talking about SolarEdge 1 for residential since its launch at Intersolar last year, and have been consistently releasing new features into the market. One very topical example of SolarEdge 1's benefit is currently taking place in the Netherlands. In the last year, many utilities in the Netherlands have adopted negative rate policies in which at certain times, consumers who export power into the grid are penalized for the power they are exporting. To alleviate this, we introduced the negative rate optimization feature that through integrations to the energy markets knows when export rates turn negative and automatically stops exports of energy and maximizes consumption from the grid, providing customers with incremental savings. Beyond the Netherlands, this capability has already been rolled out to Belgium, Sweden, and Poland, and will be rolled out to additional countries on an as-needed basis. As it's a cloud-enabled solution, this feature can serve our entire legacy fleet, as well as new installations of residential and CNI systems. Since launching the feature late in 2023, over 9,000 customers have registered for it, and there have been more than 70 events in the last 3 months where customers have saved money using the feature. Another important software feature that we are in the process of field testing is dynamic rate optimization. Dynamic rates are complex energy trading methods where utilities publish the electricity import and export rates every day for the next 24 hours, which change dynamically throughout the day. The SolarEdge 1 energy optimization algorithm imports the rates from the utility company and optimizes PV production, energy storage, and energy consumption to maximize homeowner savings. Through the strength of the algorithm team that we have built in our R&D group, we aim to provide a best-in-class energy management software suite in order to generate maximum savings for our customers through a simple and user-friendly interface. I will now hand it over to Anand.
Thank you, TV, and good afternoon, everyone. The market situation, which resulted in lower revenue levels in the fourth quarter and in the next quarter, creates various anomalies in our financials, which I would address today. For full comparison between our financial results for the quarter and the same quarter last year, please refer to the press release issued today and to the supplemental materials posted in our investor relations section on our website. Total revenues for the fourth quarter were $316 million. Revenues from our solar segment, which includes the sales of batteries, were $282.4 million. Solar revenues from the United States this quarter were $112.8 million, representing 40% of our solar revenues.
Solar revenues from Europe were $120.5 million, representing 43% of our solar revenues. Rest of the world, solar revenues were $49.1 million, representing 17% of our total solar revenues. On a megawatt basis, we shipped 283 megawatts to the United States, 335 megawatts to Europe, and 283 megawatts to the rest of the world, for just over 900 megawatts of total shipments.
Enphase made $302 million. So what did they make last quarter?
Enphase made what? 316 million.
So they made They made more money than Enphase. Enphase made 302.6 million for Q4, versus.
But Enphase kept more of it, and these guys have not.
1 million, yeah.
So if they figure out how to keep more money, basically, and they are, I think they're closing down some factories. They're firing some of their workforce. So
what are you saying, SolarEdge?
Yeah.
Oh no, so yeah, SolarEdge, yeah.
So I'm saying they're trying to probably raise their gross margin because they've been totally crushed, and they've been spending too heavily compared to Enphase, which they keep watching having 45% gross margins or something, and these guys are, I don't know, single digits now or something, or negative. Who knows?
What is it? Yeah, I'm looking for Enphase's. Yeah, it was 40-something%.
All right, let's continue this.
Shipments this quarter were commercial products, with the remaining 39% were residential. In the fourth quarter, we shipped 133 megawatt hour of our residential and commercial batteries, with the majority shipped to Europe. From a product perspective, and as a result of the high three-phase channel inventory in the German-speaking countries, this quarter our shipment was heavily skewed to single-phase batteries that are manufactured using the Samsung cells and that carry significant lower margins. In the fourth quarter, due to inventory imbalances in the distribution channels, we shipped higher portion of optimizers to inverters. As a result, ASP per watt this quarter, excluding battery revenues, was 23.6 cents, a 44% increase from 16.4 cents in the last quarter, while the typical ratio of inverters to optimizers is 1 to 24. The ratio this quarter was 1 to 30. In general, our unit prices were largely unchanged this quarter. Our battery ASP per kilowatt hour was $403 this quarter, down from $475 per kilowatt hour in the previous quarter. The decrease is largely due to an inclusion of our first shipment of our commercial battery, which carry a lower ASP per kilowatt hour, as well as the previously announced price decreases on our residential batteries. Revenues this quarter from our non-solar businesses, comprising of energy storage and all other segments, were $33.5 million. Following the discontinuation of our LCV business, this revenue is mostly attributed to our energy storage division. Consolidated GAAP gross margin for the quarter was a negative 17.9% compared to positive 19.7% in the prior quarter. Largely.
Well, there you go. Negative 17.9%.
You do that 1 quarter, man.
So it went down. It went down a lot. Yeah, the apocalypse, the SolarEdge apocalypse. Absolutely.
What is the reason for that? How do their margins go down that much on products that are already like they underproduce?
They're spending too much money. Just the bottom line. They are not efficient. They are not capital efficient. They are not Elon Musk, and they are not Badri.
Their money on them. They have to account for that.
Well, I'm sure it's accounted. I'm not going to look at their accounting statement, but I think
it's the next paragraph. The first layer of gross margin is what we define as direct gross margin. He's getting to that, which is the price paid by
operations.
Direct, yeah.
All right, let's hear it.
And restructuring activities. Non-GAAP consolidated gross margin this quarter was 3.3% compared to 20.8% in the prior quarter. Gross margin for the solar segment was 4% compared to 24% in the prior quarter. This amount includes 210 basis points of IRA benefits. Given that the low revenue environment creates various anomalies in our margin structure, I would like to spend a few minutes addressing the main drivers of our gross margins and the impact on the current and next quarter's margin levels. This breakdown will provide more detail than we typically disclose, and we will provide this additional color on our quarterly earnings calls as long as the current situation persists. The first layer of gross margin is what we define as direct gross margin, which is the difference between the price paid by our customers and our direct cost paid to our contract manufacturers. This part of the gross margin is affected by the prices in which we sell our products, the customer, the product, and the geographic mix, and the cost of components and other manufacturing costs. This margin layer is not dependent on revenue level, but is only dependent on price, cost, and mix. In the fourth quarter, direct margin was 970 basis points lower than the third quarter, a direct result of a typically high portion of large customers within our mix that enjoy volume discounts, and a very high portion of our single-phase batteries that are based on Samsung cells purchased under prices that prevailed in the battery cell market in 2022. These were offset by IRA incentives on products we made in the United States. We expect to recover most of this gross margin in Q1 due to product and customer mix changes. Total gross margins are achieved by adding additional costs of goods.
So that's what it was. That's what it was. What did he say? A high portion of large customers within our mix that enjoyed high volume discounts, and very high portion of our single phase batteries were from Samsung cells. He's saying purchased under prices that prevailed in the industry. Okay, so yeah,
but still they were overspending. That's why it's negative. I mean, there's no way to go negative unless you're overspending, because they were still making a profit to the people they were distributing to, right? So everything else that adds on top of it is what takes away from the overall, right?
Mm-hmm.
I just think they're not capital efficient. Once again, Enphase shows you how to run a business, and
Yeah, well,
I think
no-
Enphase started cutting jobs earlier. I don't think SolarEdge did. If I'm reminded, I think they're doing it now. I don't think they did it last year. I think Enphase started to do it last year.
Yeah, I don't think so either. But I want to see what they're spending their money on.
or other COGS to the direct cost. All COGS are not directly related to the product volumes sold in this quarter. Some all COGS are variable, such as shipment costs and tariffs, and warranty accrual on newly sold products. And some are not variable, such as warranty expenses on our existing fleet, manufacturing and support departments, and contract manufacturers' charges. When in the fourth quarter, we lowered our OCOGs by approximately 50% on an absolute dollar basis. The greater decline in revenue on an absolute basis led us to these economies of scale that had negative impact of 930 basis points on our fourth quarter solar gross margins. By means of example, we lowered our production and support department costs by 12% on an absolute basis in Q4, and yet these costs accounted for 670 basis points negative impact compared to the third quarter on gross margin due to lower revenue. Another example is warranty expenses and accrual, which were 49% lower on an absolute dollar basis in Q4, and yet accounted for 200 basis points negative impact on gross margins due to the lower revenue. Although we further expect reduction in the absolute dollar value spending in the first quarter of 2024, the lower guided revenues will continue to negatively impact our gross margin. This phenomenon is expected to reverse throughout the year as channel inventory clears out. Gross margin for our non-solar segment was
So at least that's a positive statement. The lower guided revenues will continue to negatively impact our growth. The phenomenon is expected to reverse throughout the year as our channel inventory is cleared out. So semi-positive. You there? I don't know if I hear you.
Yeah, that's me. The warranty expenses, that's a big sticking point with SolarEdge, that they have a lot more failures than Enphase. So they're saying, which were 49% lower on an absolute basis, had a negative impact on gross margins too. Although we've further reduction in absolute dollar value.
Well, they were lower. It means their equipment is whatever better, but
49%
on
lower.
the actual dollar amount, that's where it hits them. Like when you actually look at the dollar amounts, yet accounted for 200 basis
of
points.
negative impact. Yeah, like the percentages are great, but at some point you need to quantify that with actual in actual dollars.
All right. Well, let's at least finish this part. See what the Q&A, because so we're only 25 minutes in.
Yeah.
2.2%, an improvement from negative 23.9% last quarter, a result of higher revenues from our energy storage division and better utilization of Sella 2 factory. On a non-GAAP basis, operating expenses for the fourth quarter were $118.3 million compared to $128 million in the prior quarter. This reduction is predominantly related to reimbursements of salaries of Israeli employees that entered reserve service, as well as lower accrual for doubtful accounts and additional savings. As announced at the beginning of the year, during the fourth quarter of 2023 and the first quarter of 2024, we took significant cost reduction measures, including a reduction of 16% of our workforce. We expect our non-GAAP operating expenses to stabilize in the second quarter of 2024, and once the full impact of those cost savings is realized, we will expect operating expenses to range between approximately $112 to $117 million a quarter, while we continue to seek further efficiencies in all of our operations. This quarter, we also incurred significant discontinuation and restructuring costs in our GAAP results. As mentioned in the previous call, upon the termination of our agreement with Stellantis, we have exited the light commercial vehicle business. The Stellantis contract termination generated an inventory write-off of $36.2 million and additional discontinuation costs of $0.8 million. In addition, as previously reported, we discontinued our manufacturing in Mexico and reduced our manufacturing levels in China. Our GAAP results for the fourth quarter include $23.2 million of restructuring expenses, the majority of which relates to contract manufacturer charges and equipment retirement costs. GAAP operating loss for the quarter was $237.6 million compared to an operating loss of $16.7 million in the previous quarter. Non-GAAP operating loss for the quarter was $107.8 million compared to an operating profit of $23.1 million in the previous quarter. Non-GAAP financial income for the quarter was $30 million compared to a non-GAAP financial loss of $7.4 million in the previous quarter. Our non-GAAP tax benefit was $25.5 million compared to a non-GAAP tax expense of $46.6 million in the previous quarter. Our non-GAAP tax rate for the year was 27%, and we expect it to decline over the next several years. GAAP net loss for the fourth quarter was $162.4 million compared to a GAAP net loss of $61.2 million in the previous quarter. Our non-GAAP net loss was $52.5 million compared to a non-GAAP net loss of $30.1 million in the previous quarter. GAAP net diluted loss per share was $2.85 for the fourth quarter compared to $1.08 in the previous quarter. Non-GAAP net diluted loss per share was 92 cents compared to 55 cents in the previous quarter. As we discussed, we expect to reach an underlying business run rate of $600 to $650 million in the second half of the year, and we expect the process of inventory normalization to last until the end of this year. We continue to expect that at a revenue level of $600 to $650 million a quarter, consolidated non-GAAP gross margins would return to 30 to 32%, including approximately 500 basis points of benefit from IRA manufacturing tax credits, and operating profit margins would return to 11 to 14% after implementing cost reduction activities. Turning now to our balance sheet. As of December 31st, 2020.
Well, this part was important, at least.
That was the most important paragraph right there.
Yeah.
That was
So let me see. Consolidated non-GAAP gross margins would return to 30% to 32%. I guess that's next year, right? That's 2025 probably.
when he says this, when he says where's the thing he says? When he says we expect the process of inventory normalization to last until the end of the. It's so funny how they use these freaking ridiculous terms to make it sound better than it is. What he's saying is that they expect to have inventory that they still need to sell through all the way through the end of the year. So
Yeah.
they're not expecting to ramp their production back to pre these levels until the end of this year. So if you want to buy SolarEdge, you've got until the end of the year. You've got basically 10 months to just keep accumulating this.
Should have bought NVIDIA. Should have kept NVIDIA.
Yeah.
All right, but it seems like sometime next year they're back to profitability. Operating profit margin would return to 11% to 14% after they implement these cost reduction activities. But he doesn't say the business is basically going to get better. It's cost reduction that's going to get them there.
Yeah, but it's also a sign. It's like one bad quarter and they go from 32% profit gross margins that to negative something percent. They're just not financially managing the business correctly. Where look, one bad quarter, you could say, is doing this.
Well, yeah, they're still spending too much money. So from here, the run rate of 600 million to 650 million the second half of the year. So, yeah, I mean, they have to go further into cuts, but I mean, honestly, I don't know why they're spending this much more and why their gross margins have tanked this much. Because
the 2 paragraphs down, that's the solution. I'll be right back. You can play it, but I'll be right back.
All right.
Cash equivalents, bank deposits, restricted bank deposits, and investments were $1.3 billion. Net of debt, this amount was $634.7 million. This quarter, cash used in operating activities was $140 million. This cash utilization is a direct result of two main factors. First, we have extended payment terms to certain customers. As a result, our DSO increased from 149 days in the third quarter to 265 days in the fourth quarter. Second, our inventory level increased significantly to the abrupt slowdown in demand. Our inventory days increased from 169 days in the third quarter to 386 days in the fourth quarter. We expect to see a slight increase in inventory levels in the first quarter as we ramp our U.S. manufacturing, which along with the lower guided revenues will result in higher inventory days. This trend of increased inventory days is expected to begin to reverse in the second quarter of 2024 once revenues return to growth and as we manufacture less products. We did not buy back share in this fourth quarter, and we expect to start executing our $300 million stock repurchase program in the first quarter of 2024. Accounts receivable net decreased this quarter to $622.4 million compared to $939.5 million last quarter. As of December 31st, our inventory level net of reserve was at $1.4 billion compared to $1.2 billion in the prior quarter. The increase is solely attributed to higher finished goods inventory, a result of the abrupt slowdown in shipments, offset by a decrease in raw material inventory. Turning to our guidance, as discussed in our earnings release for the first quarter of 2024. We are guiding revenues to be within the range of $175 to $215 million. We expect non-GAAP gross margins to be within the range of -3% to +1%, including 850 basis points of IRA benefits. We expect our non-GAAP operating expenses to be within the range of $122 to $130 million. Revenues from the solar segment are expected to be within the range of $160 to $200 million. Gross margin from the solar segment is expected to be within the range of 1 to 5%, including 900 basis points of IRA benefits. I will now turn the call to the operator to open it up for questions.
To ask a question, press star 1 on your phone keypad. And to remove yourself from the queue, press star 2. Again, that is star 1 if you would like to ask a question. Our first question comes from Andrew Perocco with Morgan Stanley.
Great. Thanks so much for taking my question. And good evening, guys. So maybe just kind of starting out on the margins here. Apologies if I missed all the numbers, but I think you mentioned about 970 basis points or so of impact from volume-driven price discounts and some battery mix shift. Can you maybe just kind of reiterate or go over those numbers again in terms of how much you expect to come back in the first quarter, and then maybe a cadence beyond the first quarter in terms of the back half of the year where you expect to get and how you get there? Thank you.
Sure, and thanks for the question. So first of all, to explain a little bit again the term of the direct gross margins, and then what are the impacts. In general, there's a price that we charge our customers, and this price has not changed dramatically in the first quarter, as we mentioned before, other than batteries, where we started to increase costs, as previously mentioned. The second part, of course, is the cost that we pay to our contract manufacturers, and this is also, by the way, something that's relatively fixed, given the cost of bill of material and manufacturing costs with our contract manufacturers. So when we look at the first level of this direct gross margin, the only difference that we have when we have a certain level of revenue is what is the amount of customers that has, or the size of the customers that have different volume discounts. That's number one. And number two, which was actually a little bit more important and influential this quarter, is what is the mix of our products. So the first thing I would say that with these 970 basis points loss of gross margin compared to the previous quarter, a lot of it is actually related to the fact that our portion of single-phase batteries was much higher than in the previous quarters. Now, we need to remember that these are batteries that we manufacture based on cells that we acquired from Samsung, an agreement that we signed at the very end of 2021. At that time, by the way, NMC battery prices skyrocketed, and as a result of this, and since this was related also to the raw materials index during the war in Ukraine in 2022, those prices went up dramatically. And that means that today, when we're selling batteries, single-phase batteries made on these Samsung cells, our gross margins are very, very low. The second thing that happened is that actually in this oversupply environment, some of the customers that managed well their inventories and were able to either grow and actually need products to maintain their growth were large customers with very strong buying power. And therefore, in general, these will be customers that usually will be, I would say, less than 20% of the overall revenue. This quarter, they were like 60 or 70% sometimes of the overall revenues. Again, these are just numbers by means of example. So that was the second part. But I would still say that the biggest difference was, first of all, coming from the batteries and then from the customers. So I hope it helped on that side. What happens next quarter? So next quarter, two things are happening. The first thing is that across the mix of products, the that we expect to see, and customers, we will see a little bit less of these very large customers with lower gross margins, simply because of the fact that, again, they have right now what they need. And the second thing is that the overall portion of the single-phase batteries will most likely be slightly lower compared to what we saw this quarter. And that means that we expect the majority of these 970 basis points to come back. Not all of them, but the majority. I will end up with one more thing, Andrew, and I think that it will maybe be a thing that we will discuss over this call. The situation that we see today, as mentioned by CV, is that the channels are very much filled with inventories because of all of the dynamics that CV mentioned. And what we do see is that today customers are not buying a typical order from SolarEdge as they used to do before of X inverters and X optimizers. In some cases, these customers are stopped buying, and they buy only those things that you see. And this is why I sometimes see a little bit of an abnormal situation where a customer is buying only inverters because they have too much optimizers. This quarter actually it was the other way around. We saw a lot of customers buying more inverters than optimizers. Sometimes, more optimizers than usual in the ratio of inverters. We may see, as we mentioned this quarter, that the three-phase batteries in the German countries are relatively heavy on the channel inventory. But once they start to be clear, then we will see higher purchases of these products that enjoy very nice gross margins. So I would say that
I think you missed one part, which was critical. The reason their gross margin also collapsed is because the partners who they give massive discounts to ended up being a larger portion of the people buying their batteries.
Mhm.
And usually it's around 20%, he said, but it was 60 to 70% approximately. And at the same time, the deal that they had for the Samsung cells was from 2021, where the materials were
Super high.
incredibly high.
Yeah.
And all those prices collapsed, but they still have to get rid of all of these. So the margin on all that, those batteries that they're selling is basically nothing, or very low.
Mm-hmm.
And so he's saying that's going to correct over time. So I thought that was an important little bit there.
Mm-hmm.
So it looks like they're dealing with maybe worse than Enphase, I don't know, but dealing with the material cost from 2 years ago that they made deals on.
Yeah, and they've still got these products laying around that they got to move.
Yep. All sounds bad.
level
Yeah.
that we saw before is mostly related to the stabilization of the inventory situations in the channel, which again we expect to see in the second half of the year, because then we will start to see that the level of inventory is normalized, and you see a little bit more, I would call it reasonable or natural ratios of products.
Great, that's super helpful. And then maybe just one follow-up question on demand. Sounds like you're still bullish on a European demand acceleration beyond the first quarter, both for residential and commercial, but still somewhat more muted and negative on the U.S. outlook for 2024. Can you maybe just help us bridge the gap there? What's driving the demand in Europe? Is it just purely power price driven? Is it energy security driven? Because it seems like the macro environment is somewhat similar in both geographies. I'm just curious, what gives you more confidence in the medium-term outlook in Europe? Thank you.
Yeah, we tried specifically actually to break it down to four segments, if you will: residential in Europe, commercial in Europe, and residential in the U.S. and commercial in the U.S. So in Europe, I don't know if the word is bullish, but we believe that there will be growth from the rates that we were in the fourth quarter and in the first quarter, primarily based on seasonality and historical breakdown of installations and revenue in Europe between the various quarters. And that combined with some of the regulatory clarifications that we mentioned, both of these elements together in our mind translate to the fact that from the first quarter and on, there will be a gradual improvement in installation rates and clearing of inventory and eventually of revenue in Europe. And this is true for both segments, residential and commercial. Overall, the expectation is for stronger growth in commercial than in residential, related to the market dynamics and some of the enterprise push for decarbonization. That relates to Europe. And in the US, we see a very different pattern between residential and commercial, and that we've been seeing already. So as I mentioned, commercial from an installation rate and sell-through point of view is continuing to grow. It grew significantly in the fourth quarter compared to the third quarter, and we are at record historical levels from that perspective in terms of sell-through by our distributors. There's still time until the inventory clears, and that begins to translate into revenue for us. But we are relatively optimistic about continued growth in the commercial market in the US. Again, a lot of it is driven by enterprise module prices, and at some point also availability of IRA product that I mentioned we will begin to deliver in Q2 and deliver in volumes in Q3. So that is the source of why we expect a positive trajectory on CNI in the US. And residential in the US is the segment where we are less optimistic about growth, at least in the short term, and expect the market to continue to be a bit slow, with gradual trends of people realizing how to sell and operate within a NEM 3.0 environment in California. And we see this slow growth trajectory in that regard, and availability of IRA products later in the year, and especially installers and TPOs learning how to construct their business so that they can benefit from.
What?
It's funny how all they talk about in the U.S. is California.
Yeah, it's
like literally, they're like in the U.S. market, this in California, that in California.
Well, it is the bellwether, I guess, and other states do seem to be following and making also bad, attacking net metering,
Mm-hmm.
So New Jersey, not yet, by the way. I still get 1-to-1 credits here. So if I put something in the grid, I get it back exactly 1-to-1.
Mm-hmm. They'll take that away from you soon enough.
Well, I think I'm under the agreement for 10 years. So maybe new people eventually will be taken away, but I think I'm under the 10-year.
How long that is.
Yeah. You ready?
Yeah.
And that should help push the market forward a bit in the later part of the year. But this segment out of the three is the one that we see as more stagnant. In Europe, we see gradual growth in residential and commercial, and in the US, we expect continued growth on commercial. All of this, again, from the perspective of installation rates and point of sale, that will eventually clear the inventory and result in our revenues as well as our expectations.
By the way, real quick, it's 20 years.
Thank you.
20 years for what?
April 15th, NEM 2.0 closed to new customers and new solar billing plan went into effect. NEM discounts will continue to bill under the current NEM program until the 20-year period expires, or until the account loses eligibility to remain on the NEM program, whichever is earlier. So someone like me, grandfathered in, yeah, if you were before this date, blah, 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 you can be eligible for NEM 2.0 credits for 20 years following the date that your system was given permission to operate. So the day
Right.
you
So
got your PTO,
you probably have 15 years or so left, something like that.
yeah.
All
More.
right.
Next question comes from Philip Shin with Roth MKM.
Everyone, thanks for taking my questions. Want to explore your capital plan a bit more. You guys are talking about potential for a buyback, and I think your cash and debt is roughly 600+ million. Seems like you may have burned 200 million in Q4. If the macro remains challenged through the first half of this year, could you guys be in a situation where you need to raise capital? Can you talk about your plan to manage the liquidity dynamics in general, and how much cash you would like to maintain on balance sheet? Thanks.
Sure. So in general, cash flow for operation this quarter was, as mentioned, about $140 million. And as usual, you also have a little bit of capital expenditures. When we look into the next year, let's first of all try to understand the cash dynamics, and then I'll discuss the capital allocations. We're basically going into a few quarters where quarterly revenues will be lower than the AR balance that we have right now, which is approximately $700 million of AR balances, which we will collect them. We collect them slower than we want, given the fact that, again, some of our customers are seeing difficulties, but we're confident in our ability to collect those. The second thing that will happen is, of course, the fact that since we're seeing in such large inventory levels, these are products, of course, that are not expected to be replaced over the very near future. For example, in our optimizers, we've just started our fourth generation selling of these products this year. These are products that usually don't have shelf life, and therefore we expect to see that a lot of our revenues in 2024 will be continued to be sold from the inventory that we currently carry, where the manufacturing that we will do will come mostly in the US, for IRA purposes. We want, of course, to capitalize on these benefits, and second is in other places because we want to maintain our manufacturing capability for the next year. By this, the result should be is that 2024 is going to be most likely a year in which we're going to generate a substantial amount of cash, at least I would say from the second quarter, once all of these trends will start to reverse. So in that sense, we do expect that cash flow will raise again, and it will be, unfortunately, when you're not growing so rapidly, I would say working capital needs are usually less pronounced. The second part is, when it comes to the capital allocation, is the fact that we will not execute the plan as long as we do not feel very comfortable with the cash position that we have. We feel very comfortable today that acquiring the SolarEdge shares by the company is a good use of the cash of the company. We will do it in a very...
So FYI, they're buying $300 million worth of their stock. If you missed earlier, they said what they were buying.
Yeah.
Which I don't know if that's a good use of capital. Yes, it's cheap, but I don't know if it's a good use of capital when your business is tanking this hard.
Yeah, but I think that that's just to stop the bleeding.
Maybe it's a show like, look, we have enough cash.
Yeah.
And we expect to turn the ship around. That's
It's a sign of confidence, right? To say that we expect to have more cash to replace this, so we're going to give this to our shareholders.
I mean, $300 million on a $4 billion company.
It's a substantial amount of the flow.
Well, let me take out the calculator here for a second. So it's going down, right? But so let's see, 4,000. If we have 300 million divided by 4 billion, I think it's 7.5%. If I did that right. Yeah, 7.5% of the company they're going to buy this quarter. They said, I think Q1, they're going to buy 300 million of stock. And if it's tanking right now, that might be more than 7.5% of the company.
What are they saying? They can do that now, or they just approved it for like the year?
No, they said they were doing it in Q1. Hold on, I didn't want to lose my position. Philip Shen, let's remember that, but I can look up 300 million. Here, demand in the first quarter. Hold on. No, that wasn't it, right? Here, we did not buy back share in this fourth quarter, and we expect to start executing our 300 million stock repurchase program in the first quarter of 2024.
Look at this, though.
You're showing something?
Yeah, look at this. This is what they're responding to. Look at this, dude. This is insane.
that's
I mean, do you understand?
That's a bloody mess.
This is insane. This is where you think that solar had sort of reached a new plateau, and you're looking at 190, 120.
I know. That's when I actually started picking up shares.
And then, I mean, look at this. This is massive institutional sell-off, dude.
I mean, yeah.
These are actually these are weekly candles. Let me see what.
It doesn't matter. It's just all selling. There's been no buyers coming in. Absolutely none.
Yeah, this is horrendous. And
today it's down 15-20%, right? Or yesterday.
Yeah. And you don't want to see massive gaps like this on the downside. On the upside,
Well,
it's one thing, but look at these massive gaps.
what was take a look at before this run. What price were they at before this run?
Before this run down?
No. Before this whole run up.
Oh,
So
before
what
the
was that?
run
What year was that? What were they at?
is hold on, let me get rid of this. This is 2020. So this is actually look, this is March 2020. This is the COVID dip.
So right before then, what were they at?
Well, we are at the COVID dip levels. The
Well,
Fed
well, that's
started
what I'm saying. What's the price of the COVID dip? What was that price?
right here. Look at it. 68.
$68. And so we're around that price.
We are, I mean, we're basically all of those COVID gains have essentially been erased.
Well, the thing is,
It's a big
in this
head
case,
note.
it's warranted, by the way, because all of their gains have been erased.
Yeah.
So it's sort of warranted. They should be back to whatever level that was, 2020, 2019.
Yeah, but that's just one quarter. Think about this. One quarter.
And the thing is, it might shoot down even lower just because things go further than they should. So
They
yeah.
do. I mean, now you're talking. What's the next real level is down to $33. This would
Yeah,
be, I think, a sub
$40
$40 company.
Look, it's possible because they're going to announce they're buying back their company, true, but $40, $50, why not? I mean,
Bro,
another
if they
terrible
do
quarter.
anywhere down here, if they do get anywhere down here, I would take back what I said and I would just buy a bunch of call options on this.
I mean, same here. I'd have to gamble some more money on it.
Both shares, but I would just buy some call options because why not?
Yeah, for the
Right.
eventual either collapse or recovery.
Yeah, but this way, if you're buying calls, you're like, okay, I'm gonna risk $1,000, $1,200. I mean, also at that price, if they're $30, what are these options going to cost you? Nothing. You know, $30, you'd be $3 a share. You know what I mean?
I mean, there might be. Yeah, I mean, honestly, honestly, even if it's $10, like a big deal. Like if it's 25%, if it's $40 a share, and you're paying 25% on this crazy call because the volatility is insane. Well, then you're risking $10 a share for possibly God knows what, a 10x. You know what I mean?
Yeah. So you risk a couple $1,000, but you have a massive upside because of how much spending power you have.
Yeah. So I mean, I feel I have enough. Honestly, I have enough exposure to SolarEdge right now.
Yeah.
So I will wait for the $40, $50 to happen before I can start getting more. 20,000 purchase.
All right, let's skip through this. I can't stay on too much longer. It's my
Yeah,
mother-in-law's
let's see.
birthday today.
It's your wife's birthday?
My mother-in-law's birthday.
Oh,
Today.
they're not as important.
Well, she's also staying with us and helping take care of the kids. I'm like, all right, we'll
Alright.
take you out for some dinner.
Let's see if we can get through 5 more minutes.
Well,
Way to make sure that we are matching the pace of our purchasing of stock.
Again?
We want to hear them say. They should really have it so that if you click on the text in the
I know they don't do that. That's really
go
annoying.
to the freaking, it should go to that part.
Yeah, I agree.
To the pace of our cash generation in order to make sure that we're not running if something goes bad into a problem. And in any case, of course, we are going to be very, I would say, concise on how we're going to continue and generate the cash flow from the inventory and customers. So I think that right now we do not see that we will need to raise capital. I believe that we will actually generate a little bit more capital, and we believe that buying stock or shares is the right solution. I will just end with one more thing, and this is the CapEx spending. The general trend is that since we're reducing manufacturing footprint, of course, we will invest much less in capital expenditures related to our manufacturing capacity increases we did in the past. So, for example, some of the activities that we're ramping right now in the United States can be supported by equipment that we have already purchased, by testing equipment that was already built and is now being mobilized from other factories. So all in all, we see low usage of cash, high generation of cash, and a very measured and responsible purchase of shares, which we still believe that at this time is a good use of our money.
Brilliant. Thanks for all that color. Shifting over to the demand outlook in Q4. It was 500 million Q4, and now you're saying back half 650 million. Can you talk about the year-over-year growth? It shouldn't really be seasonal because we're really comparing Q4 24 to Q4 23, and then also when you get to that level of
this
again,
is it.
What do you expect the new gross margin outlook to be on that $625 million at midpoint, excluding IRA and also with IRA? Thanks.
So first of all, I'll start from describing the I would call it revenue environment between the two Q4s, and then I'll answer the margin. As I mentioned in the prepared remarks, we saw that the Q4 sellout from or sell-through from our channels being approximately $500 million, which, by the way, based on our estimate, was actually even below the installation rates that happened throughout the 24. We do understand that, Q4 23. We do understand that two things are happening, and especially when we look into the beginning of the year. The first thing is that we saw a decline in the installation rates in the fourth quarter of 23 towards the end of the year, which is something that is usually happening because of the overall holiday season and the fact that actually winter in Europe started relatively early this year and was relatively strong. And therefore, our belief is that throughout the year, first of all, the fact that you will see seasonality in Europe going back at least in the second and third quarter
is something that we expect to increase the underlying demand that we saw compared to Q4. And since we're under shipping to the channel at this point of time, we will simply have to eventually adjust into these, I would call it installation levels that we see. And this is why if we saw $500 million of sell-through and a higher installation, when we look at the markets one by one, we believe that we'll see at least, if not higher, installation rate at the end of 24. And by the way, this is not including new products that Stevie mentioned that are not baked into our plan, such as the commercial batteries, such as the trackers, such as the 330 kilowatt inverter. So we feel very much confident on this when we're looking at market by market. Once we are going to go through this year, what will happen is that we expect that we will eat the majority of the inventory or excess inventory that is in the channel, which we, by the way, at least at Q4, estimate about a quarter and a half worth of inventory, excess inventory, sitting in the channel. And what we will see is that, as the installation rates are continuing, our undershipping will go down quarter by quarter until, again, we believe that at the end of the fourth quarter, they will be relatively minimal. So that's how we view the trends that we see. And again, these are based on discussions that we had with our customers, analysis of historical trends that we saw, seasonality, and market by market also from political and other regulatory environment. Gross margins in this situation. So when it comes to the gross margin, as I mentioned in the prepared remarks, we expect that once we're back at $600 to $650 million of revenues a quarter, we should be at 30 to 32% gross margins, which already includes 500 basis points of IRA benefit. And the way to get there is actually twofold. One, of course, is our regular product gross margin that will not change significantly from a cost point of view because of the high inventories, and we actually bake in a small ASP erosion throughout the year. So we expect actually here that the cost will be relatively flat, but price is going a little bit down, but we will see a much more normalized distribution between geographies and between customers, and therefore product margins will go back a little bit. The second thing is this OCOGS part that we discussed in the past. And here, first of all, the combination of our cost-saving measures taken in Q1 when it comes to reduction in force, the closure of Mexico and reduction of China, coupled with a lot of work that we did in the quality of product front, starting from changing components in our products to automotive-grade components that already shows a lower, of course, failure rate and therefore requires lower cost of service of warranty and also lower warranty accruals, and also a little bit of fixes that we did to our existing fleet when it comes to software that also reduces this amount. So we expect to see, even compared to the last time that we were at $600 million, a little bit of a lower fixed cost or OCOGS that we saw before. So these will be the drivers that we currently see when we aim again being at 30 to 32% at $600 to $650 million of revenues.
Thank you. Our next question comes from Ryan Lee, Sachs. Hello, Mr. Lee, your line is open.
Hey guys, sorry I was on mute. Thanks for taking the questions. Ronen, I apologize. I'm going to kind of beat the dead horse a little bit here, but in a follow-up to Phil's question. So if we bridge, I know you gave a lot more gross margin clarity than you typically do, and it sounds like you'll do that for the next couple quarters. But it sounds like there's 900 plus basis points direct, 900 basis points plus of some of the other COGS. So given where you're guiding to for Q1, basically like flattish gross margin, you've got like 1,800 basis points you've spoken to. What is the remaining bridge to get to 30 to 32? I guess that's what I'm struggling with because there's you've identified about 20 percentage points. Where does the other 1,000 basis points come from? And then just a follow up to that would be, previously you talked about 500 basis points included for IRA credits. That was before the 45X clarity on optimizers being applicable for 11 cents, came out in December. So has your view changed there, or did you always embed 11 cents as your base case? So you're just trying to understand all the puts and takes, but definitely the bridge to the final 30 to 32. Thanks.
Okay, I'll try to explain. So I'll start from the second part, which is easy. As we said all along, our assumption was that we will get the 11 cents when it comes to optimizers, and therefore our 500 basis points is already.
That's interesting. He said we're getting 11 cents for optimizers. You there? You're mute.
Yeah, 11 cents per watt for optimizers that they make in the United States.
Well, but you're right, but it's supposed to be 6.5 for optimizers, 11 cents for microinverters. So that's interesting. I did not know that. So that means they're in parity with Enphase. It is possible. I don't know, but the language says microinverters in the the thing we saw for the IRA. So I've never heard this before, that they actually said 11 cents. This is interesting.
Yeah, but wait, what we will get when it comes to optimizers? But did the IRA mention anything specifically about optimizers?
They do. They say optimizers are 6.5 cents and microinverters are 11 cents. So I don't know if they're misspeaking or maybe something has changed. I have no idea. So this is very interesting.
Yeah, well, combined with the fact that their inverters are an order of magnitude larger capacity-wise than a single Enphase. So if it's a 750 watt microinverter, they'll have a 6,000 watt.
But this is per watt anyway. So my point is, if it's 11 cents per watt, whatever size of it, they would get it times the wattage of the inverter.
Right, but they're pairing these optimizers with high capacity inverters as well. So theoretically, or at least the back of the napkin math sounds like they'd be making more money on the IRA than a comparable Enphase system would. Because Enphase doesn't have the brain. You understand? Enphase,
no, I know, but nobody's giving you for the actual inverter. It's microinverters that are 11 cents and optimizers are 6.5 cents from the IRA that I read. Right. Here he's saying the optimizers themselves are 11 cents.
Right. But a SolarEdge system also has an inverter that also receives a benefit. So
I don't know about that. That's what I'm saying. I'm not sure what the benefit is for the inverter.
It's the same.
Besides the 30% tax credit, I don't know if there is another. Well, that's for all solar, just in general, 30% tax credit. But I got to look into this. This is actually interesting, which
I mean,
would mean
honestly, it's cool just to know what the answer is. But the more that this call goes on, the less confidence I have in the company. One or two
interesting.
quarters of just some bad inventory management, and this company is scrambling right now, firing a bunch of people. They have to. He said he's been a bit confusing. He said earlier in the call that it's going to take 4 quarters to move through the inventory, and just now a different guy said that they expect to have burned through their existing inventory in a quarter and a half. It just seems like this company's not managed very well. That their overall business strategy, right? Their overall strategy of going in sort of the low end, high volume, lower margin is not working for them. It's just not working because they say that now, but they're making a full year guidance in February right now when you know so many things could change, and they don't seem to be responding well when things are.
Well, I don't know if they guided for the full year. The inventory portion, they said we expect to sell throughout this year.
Said of like I don't know 20 seconds ago that he was that it's going to take a they should be able to sell through it in a quarter or two.
Right, but I think what they're well, at least the way I took what he said, I actually know what you're referring to, is that it's going to take them for the majority of this inventory for the next 2 quarters. It's going to be mostly gone. That's in the channel.
All right.
But there's 2 other quarters where there's going to be still lagging effects where it's hanging on. But they said that it was going to start turning around in basically Q2, right?
Mhm.
Q2, Q3. So, but it doesn't mean that they can produce as much as they want because there's still of that lagging effect of the inventory channels clogged up with whatever amount of inventory, right?
Seems like you've got a lot. It seems like
I mean, they obviously mismanaged. That's why the stock
I mean,
is getting.
look, Enphase did the same thing, but I can't find anything specifically on the Enphase call about how long they think it's going to take them to burn through it. But I mean, look, on the Enphase call, they had, Enphase call, they talked about next generation batteries, including 3-phase batteries for Germany. They expanded to new countries, UK, Sweden, Denmark, Switzerland, Austria, Italy, Belgium, all within the last 12 months. They have
It sounded more positive, basically.
new microinverters sold in India, Mexico, Brazil. They have the new 480 watt AC with much higher subsidies. I mean, they had 586 million of free cash flow. 3.3 million shares were already bought back for 410 million, and they have 1.7 billion in cash on the balance sheet. Electric car charger sales were up 7%, and they achieved 50% gross margins, including all the subsidies. So, just in general, Enphase is a better run business, just way better run, and they are not stopping. He did say that they reduced their labor costs so that they don't have to cut their R&D. Okay, so they're still, but let's hear some new products. Are you just going to manage this?
Enphase was smart enough last year to cut people. These guys have waited. I think that's a big deal.
It's 60% of the workforce. Okay, but still, where get me excited about something in the future.
Right. Well, there's no excitement here.
You're mitigating damage. Okay, you're firing a bunch of people, but that's a one-time cost savings. Okay, what give us some new products? Like, what are you guys doing?
All right. Well, let's see at least this question. I think then we call it.
Fucking hell.
A certain level of optimizers, which is, by the way, approximately 1 million optimizers a quarter that we expect to have this run rate by the end of Q3. So this is something that was already baked in the same projection that we gave. Now, actually, when it comes to the bridge to the 30 to 32%, the 2 things that you will see as we believe is that, first of all, on the product gross margin, you will see a very modest increase after Q1. Again, Q1 is already going to recover a lot of these 930 basis points that we lost, and this is because of the more balanced mix of products that you will see. So actually, on the direct gross margin, you do not expect a lot. The thing that you should expect a lot is actually the alcohol part. And I will do it very simple. If assuming that this number will be, just by means of example, $100 million in Q1 divided by $200 million of revenues, this is 50% gross margin impact. Just imagine that now we're moving into $600 million revenue. You need to take this 50% divided by 3, and here comes approximately 33% of gross margins that are just added. So that's the whole story. And to make it even more, I think, easy to explain it, that we've built our cost structure to support a company that is relatively diverse from a segment point of view, product point of view, serving complicated segments such as CNI, for example. And that means that we have a relatively heavier cost associated with this kind of a company that we've built. Once you reduce in revenues, even if you are reducing some of these costs, unless you reduce them exactly by the same level that you reduce your revenues, you see the P&L impact. And when you're working in such a small revenue basis that you see right now, the impact of gross margin is simply huge. So again, most of the bridge, economies of scale, even without changing costs on our fixed costs, most of the bridge going to 30, 32 will come simply economies of scale.
Appreciate that. Okay, makes sense. One more from me, I'll pass it on. And then this one's maybe a little bit nitpicking, but I think last quarter you said you're talking about like a $600 to $700 million revenue quarterly view, at the end of this year, kind of when you normalize. Now you're saying 6 to 650. Is there something embedded in your updated view here in 3 months? Share loss pricing. It just seems like something downticked a bit on a number in a range that may not have the most precision to begin with. So just trying to understand, one, has something changed, and two, how much confidence visibility on the 6 to 650 not maybe changing again going forward.
Okay, so I think that when we said it's 600 to 700, this is, if you remember, based on sell-through level that we saw in Q3, and we assumed that this is the level. Throughout this quarter, we did a lot of work, going deeper into our channels to understand what's happening there, looking at installation rates, dissecting almost every country by the various trends that we see there, and talking, by the way, to a lot of the installers to actually understand exactly what they see as well, which was one of the things that we did a little bit less prior to this period, and we simply were able to get the things a little bit more accurate.
They finally tried to be more accurate. Okay.
No, that didn't have any
All
problem.
right.
I don't have any problem. Just scroll through the document. Let's just see if there's anything that's worth, anything that has any good information.
Thanks for taking the questions.
First of all, the move.
I think you paid more 15.
They're really harping on it because they're saying in Q3 that they were guiding for 700 million, 6 to 700 million, and now he's adjusting it to 6 to 650 million. There's a transitory. What's like one of the final questions?
Let's see.
Let's see what they got there. Just look at the questions. Wait, inventory levels we see right now, the costs will change because I don't expect a short-term situation. And when it comes to the components themselves, first of all, we have some strategic components and strategic component manufacturers with whom we all have agreements with all that we discussed in terms of agreement how to move forward. I think the most is consumption.
Fuck that. Forget that.
I want to hear like what some new products or things that they're doing in the meantime. It seems like what they're doing is just a lot of cash management.
Yeah.
Reading stock price management, but like, tell us what are you doing?
What does the future hold, right?
Yeah. What is the R&D? Or what are you doing to try to expand when the floodgates actually open, or when rates actually do come down, or is it just more of the same? We're going to sell more inverters, more.
What's the last question? I'm sort of sick of this call.
Like, what the fuck?
A terrible call. I mean, they're going over a lot of numbers, obviously, to explain why they fucked up so bad, but there is no. Where's the light at the end of the tunnel?
Search for the word EV. See if there's anything comes up.
Just EV.
Yeah.
Hold on. I was asking for the outlook of the fourth quarter. 600 million, 650 million does not assume any inventory restocking in any way. I believe it does not, but I wanted to clarify. It assumes that distribution. So Zvi says it assumes that the distribution channel will be by then at the balanced inventory level that they typically want to maintain. That historically is somewhere in the range of 60 to 90 days of inventory. And what I experience is that most distributors and channels want to hold. Oh, there you go. That's what they're waiting for.
60 to 90 days. 90 days is 3 months. Okay.
Yeah.
They had an overproduction in November, December. Then 3 months is December, January, February, March. They should be fine. They should.
Well, no, they mismanaged. So EV, you want to search that?
Event.
I forget it. EVs, never. Electric V. No, none of that. Okay. I think that's enough of the call, honestly. I got a good sense of what's wrong. Mismanaging inventory, not getting rid of people sooner, just not talking to their customers. I think if you heard that, they said, we finally talked to and made sure of what's actually happening, boots on the ground.
Like an old school Arcimoto.
They have Friday, Hawaiian t-shirt Fridays.
Seem a little obvious.
So
I am not bullish on SolarEdge, but at that share price,
I'm bullish on SolarEdge.
On the share price, I mean, looking at $60.
Look, if they buy 7.5% of the company this year, and it still stays that way until next year, because they're going to start making cash flow again. I don't think they're a dying. I actually still don't think they're a dying business.
No, they'll be
fine. It's the PayPal model. We're hoping for a buyback that's big enough.
And, honestly, but that's what the play is here. Honestly, like I've got decent amount of end phase, and I would probably just play this for stock price appreciation.
Honestly, like I'm thinking of selling some of my shares, keeping my calls in this company, and just putting them into end phase. It is the better bet. Like this company is not exciting. They're not talking about the new things that they're doing and all the cool products. They're just financial engineering this whole earnings call, which I sort of understand. They have to explain it, but it feels like a lot of financial engineering. Value trap. There you go. I totally agree. I 100% agree. Value trap.
But the range that when things were going well, the range that it did trade between was 177 and $389. Okay, so
Yeah, but
there,
look, it can get back there, but it could take 2, 3, 4 years. We don't know, right?
right. What I'm saying though is it was at these levels for a long time. Therefore, the markets were comfortable leaving their money in there as long as the metrics showed it, and as long as the macro lined up with what they're trying to do. But it also shows what the market giveth, it taketh away, because it's basically now under that same line. And I don't know if and when we're ever going to see 177 again, which was the bottom of the range. So we
Yeah,
are.
my bet is not 177. My bet is actually between 100 and 150. That's my bet.
I mean, that's doable. It sat around in that range for a long time. But this, for me, at this point, I didn't hear anything that I like on the call. It was just literally all not making excuses, but explaining why they got in the situation that they're in and the things they're doing. It's all, like you said, financial engineering. But I didn't hear anything about like the company.
Yeah. All right. Well, thanks for the 20 people who joined us or so.
And Joe, and we're getting blamed by Valley Shop. That's Valley. I never said by SolarEdge.
I said it's a hedge.
All
by
your
the way.
HR requests to Valley, I have
it's a hedge, and apparently a very bad hedge.
SolarEdge.
Well, once again, the only thing saving us this year is basically crypto. That's what's saving us this year.
Yeah, I'm fine with my Ethereum, and I'm like, I'm good. Let these things do what they're good to do.
All right, you go enjoy your mother-in-law's birthday, and we'll see you, I guess, tonight.
Yeah, I don't know. We'll see. I might be drunk.
All right, later.
All right, bye.